Fantastic, Sunaina. Great to have you here at the virtual eMUPET this year. We will talk about the COVID-19 crisis and fund secondaries, the impact it has on GP-led and other transactions. And yeah, a warm welcome.
Thank you so much for having me again this year.
So yeah, I remember that you've been on the secondaries panel that we do have normally every year. I think like 2 years ago, I think 2018, and it was a great pleasure. So I felt we should repeat this in some form.
Yeah. Absolutely. We live in fascinating times, Tarek, where the world is changing week by week, and the secondaries market is very much trying to keep up. So a very relevant time to be back.
Fantastic. And Sunaina, you're the founder and managing partner of Cebile Capital. You're based in London, but you also have an office in New York. And maybe you want to say a few words about your firm and what you do.
Yeah, no, thank you very much, Tarek. So yes, Cebile Capital is a private equity funds advisor based in London and New York. We've been in business for close to 10 years now, and we focus on two things. We're a secondaries advisor, and we raise capital. We're a placement agent for mid-market funds. In our secondaries business, we have advised and completed 97 deals in the past 8 years alone. That's anywhere between 15 to 20 transactions per year every year. And our GP-led practice specifically focuses on mid-market GPs and finding secondaries market liquidity solutions for both LPs and GPs in the mid-market. So we've worked on many different varieties of continuation vehicle transactions, preferred equity transactions, hybrid transactions of raising liquidity both at the GP level and the fund level, and perhaps also at the asset level, and everything in between. So we're currently running a single asset secondary on a biopharmaceutical molecule that's going well. So we are known for finding secondaries market solutions to liquidity issues or asset issues at mid-market GPs.
Fantastic. And you're London-based, but it doesn't stop you from approaching also the German market. Maybe you can say a few things about that. And you may not be able to name some names, but at least maybe you can summarize a little bit what those transactions are all about.
Yes, so in the DACH market, we've been very active for a number of years. Currently, we are running the only two GP-leds in Germany, certainly, that are currently ongoing are both our transactions. In one case, we're doing a single asset continuation vehicle. The mid-market GP in question has this jewel in the crown asset. They don't want to sell it because they think there's plenty of upside left. However, the fund that currently holds this asset needs to increase DPI for its current investors. Hence, the secondaries market is a perfect bridge between those two conundrums, where a GP says, why should I sell this asset to any number of other private equity buyers who've come my way? They will now go and make a further 3x on this asset. Let me continue to hold this via a new set of investors that are given to me through the secondaries transaction. I can increase the DPI for my existing LPs who so want it, but I continue to manage the asset I know best and continue to ride the upside. So that's the first transaction. Again, a fantastic business, quite resilient even in the COVID environment. In fact, it has tailwinds because of COVID. So a transaction that we know will do very well. The second one is also a continuation vehicle transaction, but multi-asset. It's a situation where the vehicle that owns these three companies is 10 years plus old. The companies, because of COVID, what was going to be an exit pathway in 2020, it seems unclear that there are going to be any M&A exits at the values that GPs would have initially expected at the start of the year anyway. Makes a lot of sense given the age of the assets, age of the fund rather, and the GP's motivations to continue to drive value in the portfolio, raise some follow-on capital for buy and builds, and inorganic growth in the portfolio to strip these three companies into a continuation vehicle transaction. Both GPs, terrific reputations, been around a long time, household names in Germany. So we're delighted to be able to advise on those two transactions.
Fantastic. And at least I think I know that at least one of those deals is advised by my firm partners. And by the way, I'm Tarek Mardini. I'm a partner in the funds business. And while I'm not working on this one specific deal, we do have work together, and it's fantastic to see that you can do these deals even in this challenging environment. And maybe that's also a good point to start a little bit maybe more general. I mean, obviously, we are still in the middle of the pandemic. I think when it hit somewhere in February March, Europe. There was a great uncertainty. We're still now in the middle of it. There's still no possibility to have a complete, go back to the old normal. We're still in the new normality. And so what does this mean for your business, for secondaries overall, and what you see in the market?
Yes. Let me give you three perspectives, and these are the three different constituents in any secondaries transaction. The first is, what does this mean for GPs? Number two, what does it mean for existing LPs who want liquidity, who want just increased cash back from their GPs? And number three, what does it mean for the secondaries market, the buyers of these assets, given COVID? For GPs, we're seeing three pressures happening at the same time because of COVID. The first is exit windows are shut, as I just mentioned, M&A exits slower, and companies have taken a hit. Now, depending on the sector exposure, one can argue how much is that hit, but there's certainly been a hit in most sectors that GPs own. So that's the first influence of the pandemic. The second is that a number of GPs who had planned fundraisings in 2020 have delayed this. We know that at least a third of the market has delayed fundraisings to next year or beyond. And the third really is that because of COVID, there are now two types of reasons why GPs would like some new dry powder. The first is, this is a terrific buying opportunity. So if you were doing add-ons for your existing portfolio companies as a GP, this is an amazing time to go and cherry pick more add-ons and continue to inorganically buy and build your portfolio companies. And secondly, it's a great opportunity to do new platform investment. So for GPs who are out of dry powder in existing vehicles, or just out of dry powder in their current funds who want to continue to invest, the secondaries market makes a lot of sense to try to see if there's a deal to be constructed, because it can give you the dry powder for follow-ons and new investments. And it can also delay your fundraising out by a few years to allow you time to still be active in the market, yet ensure that you don't have to do the capital raise for some time. Mm-hmm. For existing LPs who are thinking about what to do now with a fund that's 8, 9, 10 years old, or just with a GP who needs to have created exits but is finding it challenging to do so, big influence we're seeing with this COVID crisis is that now these LPs are very open to secondaries market solutions to these problems. Mm-hmm. 6 months ago, even 90 days ago, Tarek, they would have told the GP, just sell this in the M&A market. Do an M&A process, advise process, and sell these assets. Mm-hmm. Well, that's not possible now unless you want to do fire sales. So these LPs are now saying, okay, if you can get me a secondaries market price and solution at attractive terms, I'm out. I will take that off. I will take that offer. And so any approach to an LPAC that says, I'm creating a valuable option for you, an option to sell or hold, becomes highly attractive to them, and they're very open to blessing that type of transaction because options have value, and now more than ever they have value because other exit paths have been turned off. So it makes a lot of sense for existing LPs. And then the third constituency, these buyers, now they went through an interesting psychological change, and Tarek, you'll know this from all your experience in the market. You know, when end of February, March hit, they all froze, going, my goodness, I am not transacting. The market was very much frozen in March and April. Mm-hmm. But in May, the interesting thing that happened was that the Q1 NAV started coming out, and they were down anywhere between 8 to 15% off Q4. Mm-hmm. And what's very clear now to the market is that between Q1 and Q2, Q1 took the equity market hit, but remember, equity markets have come back in a big way. And Q2 will factor in the EBITDA hit, the earnings markdown or earnings step down because of COVID. And the secondaries market at the same time has an incredible amount of dry powder. We surveyed the entire secondaries market post-COVID lockdown. 92% of them responded to our survey. There is $42 billion of secondaries dry powder that must be invested in deals in 2020. A number of these secondaries buyers only get paid management fee on invested capital, so they must invest to keep getting paid. Mm-hmm. A number of them have short-term investment periods, usually 3 years, maximum 4 years. So as one of them told me just last week, not deploying in 2020 is not an option for them. Yeah. And I think we've all come to the realization, some slowly, some very quickly, that COVID-19 isn't going anywhere. So governments have to adjust, populations have to adjust, communities have to adjust, and so does the secondaries market. The secondaries market is very much primed to do deals throughout the rest of the year and put that capital to work just in this new paradigm that they will have to figure out how to diligence a deal remotely. Obviously, existing relationships with the advisor, with the lawyers, with the reputable GPs, all of that comes into play. But they are fully ready now and have picked up the pens to underwrite these deals. In fact, we've launched 2 deals in the last 3 weeks, and both have had terrific reception in the secondaries buyer market.
Yeah, well, you can see definitely. I mean, from all your explanations that there is not only an incentive but almost really a pressure to invest. And so one of the things, of course, is that you have to come together as a buyer and as a seller, or even in a GP-led transaction with the GP involved. So you have to somehow find a connection between the ask bid spread and the maybe the different pricing understandings and kind of expectations people have on the buy side, on the sell side. And so what do you see, is it just that maybe the stock market has gone up and then likely the private market will follow a little bit, and that's why maybe the damage on the discounts and the NAV compared to, let's say, Q4 is not so bad, when probably somewhere in mid-end of August, the Q2 numbers will come out. So what are the options? I mean, I think we spoke a little bit in advance of this recording about maybe earn-outs and similar mechanisms. So maybe you can elaborate a little bit on that.
Yeah, absolutely. So all sellers prefer a straight cash offer. And now the question becomes, what do discounts look like off of Q1? And what do discounts look like off of Q2? And Q2, of course, as we know, we're still 3 weeks from completing the quarter, so we'll see. But in Q1, the consensus is amongst buyers that Q1 really was only a March pandemic hit. January and February mostly traded almost close to normal. And that Q2 is really taking the full EBITDA hit of the pandemic, although in Q1 you took the public comps right down. So there may be a bid-ask spread, as you rightfully said, between sellers and buyers off of Q1. In those situations, we would suggest deferral pricing, pay some of the money up front, some of the money in 12 months. That can help bridge some of the bid-ask spread. Or earn-outs, where you come up with a price, say 90% of NAV. You pay most of that, say 60 or 70% of that up front, but the rest you link to NAV development or portfolio development and gets earned out over time as the portfolio continues to come back. And so we've done earn-out successfully in some deals just to bridge that bid-ask spread, and knowing that existing LPs have a bird in hand with a liquidity option, or they wait another 5 or 6 years and monetize then. And if they've already been in a vehicle for 10, 12 years, that IRR degradation, one has to argue, doesn't make sense for them, that they will take the liquidity option, even with the earn-out having the contingencies that it does. I think most of the market believes that Q2 record date, the June 30th NAV, will be a better NAV, one of the best NAVs in 2020 to transact off of, where you've got the comeback from the multiples in the public market, but you've got the EBITDA impact factored in, that the two together should sort of give a balanced view of what 2020 looks like. There should be revised forecasts for your two companies. And more importantly, that buyers would have seen how things trade over the COVID period. Obviously everyone expects March and April to be very quiet, but as things unlocked, how did the company trade in May? How did the company trade in June? These will be important barometers. And we think that off the Q2 NAV, we think discounts will be moderate, because remember that there's a ton of capital that needs to be invested between June and December in the secondaries market. And actually, one of the more counterintuitive points in our survey, Tarek, was that buyers expected pricing to go up in the second half of the year, because deal flow is down and there'll be so much competition for the flow that does arrive on the market that'll actually bid up the pricing.
Yeah. I mean, when you compare the situation of the market and also the buyer's side, it's a bit different than compared to around the great financial crisis in 2008, 2009. Maybe it's also worthwhile to analyze a little bit the different situation of the secondary market. Obviously, it's much more developed. GP-led didn't exist at the time, not really as an institutional form. But maybe you can elaborate a little bit on this, because this will also be relevant for who is there now and what kind of toolbox we have and can work on liquidity solutions.
Absolutely. I think in the great financial crisis, what we had then was a lot of stress and distress at the LP level. It was a liquidity crisis. It was a credit crisis. And that crunch in liquidity and solvency created the need at the LP level to sell. I can tell you that one of the biggest differences with this crisis is that it's not a liquidity driven crisis. In fact, it's the opposite. LPs have plenty of liquidity thanks to the central banks of this world who've put we talk about the Fed put in the US, the ECB, QE, and so on. It's actually the opposite. They have plenty of cash. In fact, they're struggling to put the cash out. We don't have liquidity stress or distress in the system at all. So LPs, if they don't get a decent price, they'll ask the question, why should I take this write down? I don't need the cash, and I certainly don't need the write down. So it becomes incumbent upon GPs and advisors to construct deals where you actually think LPs, your existing LPs will feel good about selling and going to their own ICs with that proposal. I think that's one big difference. The second difference here is that in the GFC, while you had a lot of credit issues, you didn't have the kind of trading hit we are seeing with complete sudden stop economics happening in every country, in every economy, in most sectors of the world today. And I think that there's this differentiation between which companies survive and which companies thrive, right? And how long will the companies that survive take to actually start thriving? And I think that will factor a lot into the returns. Whereas the GFC, of course, it was a terrible crisis, but it didn't cause entire economies to stand still and have to rebuild entire companies and ecosystems. That is the case here, and this is the great unknown of this crisis. We've just started the unlock process in most parts of the developed world. Let's see how it goes.
Isn't it an advantage that most of the people around have been now through the great financial crisis, but also smaller crises, let's say like the Euro crisis in 2010, 2012, and maybe some senior folks on the veteran level who have been maybe also through the dot-com bubble.
Yes, I think that experience obviously helps. One of the things the more experienced folks who've been through the GFC tell us all the time is one of the biggest mistakes they made in the GFC is they didn't invest enough, because it was such a tremendous opportunity to pick up value in 2009 through 2012 that they wish they'd invested more. And you're right, now we have a very different market. It's 5-6 times the size of what it was. We have the GP-led market. We have very many different tools in our arsenal, like preferred equity and continuation vehicles and hybrid structures and NAV financing, and all sorts of things now that we draw from our hat here to try and deploy. So I think now buyers are saying, okay, I want to do more, but I also want to do more with some kind of risk-adjusted downside protection, because I don't know where this is going. Is there a second peak to coronavirus? Is there another lockdown, levels of lockdown that I should be factoring into my modeling? So therefore, what kind of risk reward can I be taking on? So I'll give you one example. A year ago, or even 6 months ago, earlier this year even, there were deals that were coming to market in the teens of EBITDA multiple levels, single assets, secondaries, GP-leds, even fund secondaries, they were being valued in the teens and being sold at close to par, giving them that type of teens valuation off of EBITDA. Today, I think we find it difficult for anyone to pay par for that type of valuation. So I think in these days, it's about modest valuations. And if a GP is modest and realistic in the way they mark their book, then you find that buyers are very eager to give that the fullest value they possibly can.
Yeah. That's a live recording. It's good to know and good to see that the toolbox is bigger. Everybody has more experience. I think that just in itself, that people stay calm and don't panic, I think is also a good factor. And you mentioned preferred equity. Maybe you can say a few things, because there's a little bit, something that's going on in the market. You see more people ask for it in different kind of situations, and there are several, specialized players in the market, like 17 Capital or White Horse Capital, and these kind of specialist players. Maybe you can say a few things about these things.
preferred equity is actually a really interesting and tool piece of the toolkit that isn't talked about enough, but is certainly getting its fair share of attention today. Because it allows the GP to raise liquidity fairly quickly without the usual conflicts of interest issues at the fund level or the asset level, to distribute as DPI to existing LPs, or to use for follow-on or new investments in the vehicle as you wish. What preferred equity does is that the preferred equity provider takes a preferred position in the distribution waterfall of the fund. So the first 1.3, 1.4x goes to the preferred return provider, and then the rest of the distributions go to existing LPs. If you do need capital in a win-win sort of way, where existing LPs get some DPI back and you can use some for follow-ons or new investments in your portfolio, it's a very good way to raise that capital without the usual 4 to 6 month process that a typical continuation vehicle takes.
Yeah. And do you see that even, there have been some specialist providers, do you see that more established players who maybe have been more on the equity side of things try to offer these kind of solutions? Or
I think most of the market would like to offer these types of solutions and are offering these types of solutions, which is really good news for a GP. It means that the terms of the preferred become more and more competitive, which is great news. It's not just the 2 or 3 specialist providers who are the games in town. So we can say for sure that many of the more run-of-the-mill secondaries houses are now providing preferreds. I will say that preferreds are not cheap. It's expensive money. And I think that we have to very carefully understand where a preferred is appropriate, or whether some other type of deal technology is appropriate for the GPs and for the existing LPs, who then have to take a secondary position in distribution waterfall. In some cases, they may have waited a long time already for distributions. Now, you could bridge that gap by giving them some DPI back from the preferred. That helps, but there are various considerations for your LP base that have to be carefully considered in the pref.
So, I mean, it all seems that, yes, the toolbox is growing and it's getting bigger. At the same time, it also means that there is more bespoke structuring required, because every fund and every situation is different, whether you have a multi-asset deal or you have a single asset transaction. Individual situations, sometimes it's, star assets, sometimes it's maybe really driven by more distressed situation. And the urgency for creating liquidity. So it seems you as a financial advisor, we as lawyers are more than ever somehow required to find a very specific transaction for this situation. And whether I think that's one of the lessons learned. What else do you see? I mean, do you see that now some people who are maybe normally not in there? I mean, I know in 2008, 2009, you heard sometimes of the secondary tourists, people who saw opportunities in the market, sometimes from the hedge fund area, who felt there is an opportunity. And as you say, many people regretted that they didn't buy assets in this time. Do you see this now, that actually it's getting even more competitive because people move in who have not really been focusing on secondaries at the moment?
Yes, definitely, Tarek. Just in the last 12 months alone, there have been 11 new secondaries funds formed. Manulife has hired 2 incredibly experienced individuals to start a secondaries program for them. BlackRock hired the co-head of secondaries at Goldman Sachs to spearhead a secondaries fund for them, and so on and so forth. And I'm yet to meet a secondaries fund that hasn't oversubscribed, go figure, right? So there's plenty of capital available and proliferation. You're right about the tourists. There are a number of hedge funds saying, listen, I want to participate, especially now when I think I can get more value today than I could have gotten 6 months ago, 9 months ago. So you have those types of capital. What's interesting is end institutional investors have called us and said, when a deal goes to syndication, I can't lead it, let a secondaries group lead it. But if it's too big for them, I would be happy to syndicate in. So we have pension plans, sovereign wealth funds, who have come to us and said, come for the excess capacity in a deal, we would be up for that. So that, I think, is the most obvious place. Then the other place that's interesting is that some of the large buyout managers, it's been publicly disclosed that some of them have thought about opening secondaries groups as well. So you can understand that the market is just, burgeoning in size, and there doesn't seem to be a slowdown yet. because they see that GP-leds is just so far, it's only a few years old, just scratching the surface of the possibility of what could be in the market. If you just think about single assets, there've only been a handful of single asset deals done in the last year alone. Think about the possibility of the number of GPs who could just do single assets alone. We're talking about a very, very large market here. So you can see why entrants want to come and participate and build a track record and raise capital around it.
Yeah, and not only, some of these players want to, the big asset managers, like KKR, or I think CVC was, recently mentioned as somebody or a firm that wants to expand on the secondary side. Also because the GP-led transaction often have the nature, especially if it's a single asset deal, more of an M&A transaction, and the ability to price that, to find those value add opportunities. I think that is something that actually is more natural almost for a buyout shop than for a classical fund of fund secondaries investor.
That's right. If you talk to the large buyout shops, they say, wow, I can pick up the jewel in the crown assets of all these GPs. I don't even need to manage them. The GP keeps managing them and I get to participate in that upside. This is terrific. This makes a lot of sense. Now we'll see which of them end up actually doing actually dedicated vehicles around them. But I can tell you firsthand that a number of them are thinking seriously about participating actively in that market.
Where do you see the role of the more opportunistic buyers who, as you mentioned, sometimes maybe insurance companies or pension funds who have, on a case-by-case basis, sometimes where they have been an investor in the fund themselves, know this, they hear from the GP, there's a secondary opportunity, they've been buying this. Do you see it's getting more, are they a little bit pushed to the sidelines, or is actually there's chance for them maybe on excess capacity deals, syndication type of deals, actually to maybe get their little share of the cake?
Yes, I think that on excess capacity deals, that goes without saying. A number of them have already participated in syndication efforts, and publicly so. I think that what's more interesting is what happens when they actually need to do the deal as part of the GP's own dynamics. Now, remember, one thing is important to remember: the GPs want to have a going concern. They want to raise follow-on, other funds.
Yeah.
So it's in their best interest to keep their most loyal LPs happy. And we've already had in some of these transactions where existing LPs have said, I love this asset. I am not a seller. In fact, I would like to maximize my exposure. I can't set the price and terms. Let the secondaries market set the price and terms, but please save me an allocation. And as part of the advisor's process is to collate that feedback early and know how we structure the transaction. And in that particular case, we went to market saying, hey, market, 25 million of this deal is being reserved for XYZ existing LP, which actually happens to be a public pension plan, very well-known public pension plan, who wants to, that is a maximum ticket that they want to upsize in addition to rolling their entire stake. And so you will have to do your deal math, given that allocation to them. And we can message that early. It becomes very important for advisor and GP to go to existings early on to understand how they view the portfolio and whether they're a buyer or a seller or ambivalent and can't make up their minds, which is absolutely fine. But it's good to have that information up front so you know how to structure the deal.
Yeah. Do you think that gives also new secondary buyers who come to see and look at these assets a confidence that they're, the people who know it actually are willing to, not only the GP but also the existing LPs really to have a share in that?
Definitely. I think that it goes without saying that vote of confidence is great. Now, let me give you the flip side of that coin. There is no secondaries without some sellers, right? Somebody needs to sell. So, we have seen some buyers get aggressive on this front, saying, listen, I'm not going to do 4 to 6 months of work and find out that everybody loves this GP, loves the assets, and no one's going to sell because I need a minimum amount of secondary to make this whole thing work. Yeah. So what a lot of buyers are now talking about, but certainly a few are already doing, is putting a cap on the percentage of LPs that are allowed to roll as a way to guarantee or at least maximize the size of the secondary they need to have at the end of the day. It's a slightly more forward-footed tactic, but at the end of the day, you do 4 to 5 months of work, you better ensure there's a deal to be done at the end of the day at the minimum levels that these buyers need. It's something that certainly hasn't been done as aggressively in Europe as it has been in the US, but I'm sure it's coming because with so many market participants, we need a certain deal to make the whole thing hang together.
before the COVID crisis came along, I think one of the new trends, other than single asset deals, was the early start of kind of strip sales, where you don't have the whole asset, but sometimes just a percentage of the asset. It could be single asset, but more often it could also be a little package of assets. And that was something that I heard in the market more often. People were thinking about it. Often it was still in the construction phase, and not so many deals like this happened, but it was something where people thought there could be maybe the new growth area. What do you think now? Is it?
I agree with you. We were talking about a lot of strip sale deals last year and certainly early Q1. We haven't seen that many get organized since COVID hit. I think there will be more opportunity for that as there becomes a need for just DPI increase strategies, period, as opposed to on a single asset or just restructuring the entire fund. How do you release DPI? I think in strip sales, the key to a good strip sale is that you've got to have an alignment of, as there always has to be an alignment of interest between the existing LPs and motivation. And in strip sales, even more so, because you need to make sure that they're being sold. For example, with one GP who wants to do a strip sale, it turns out that because it's so early in the investment period of the fund is currently marked at slightly less than 1x. Why would the LPs do it at that level? So you've got to take into account where exactly in the fund's life are you doing the strip sale, and quite frankly, why? In 2020, I can think of many rationales, all starting with COVID-19 in front of them, why a strip sale makes more sense. But certainly we will see more impetus for that, because of course, one of the excuses and one of the reasons for an LP to turn down a fundraise is not enough realizations. All the GPs out there who are listening to this will nod as I say this, that this is one of the most constantly heard refrains in the LP market. Well, a strip sale solves that. That gives you full bullet DPI increase day one, no preferred issues of being higher or lower in the waterfall thereafter. It's a nice way to do a DPI increase and then enter your fundraise.
Yeah. So we've talked a lot about, GP-led, preferred equity, some variations of these things. What about the more plain vanilla portfolio transactions? From my understanding, it's been rather quiet a little bit on the front, and people struggle a bit with pricing things. On the other hand, there's also not a rush, is my feeling, of distressed sellers. Maybe it's one of the difference also compared to the 2008, 2009 crisis, where there's some really people who had an issue. And I think there's several factors. My observation is that many people have increased their private equity or alternative assets percentages within their own portfolio, so they can do more now. Then the denominator factor is a little bit different. Maybe you have your own observations here.
I think you're spot on that while there was some signs early on March, April, that there may be denominator effect, now LPs are saying, what denominator effect? The public markets are back. I don't have a denominator effect issue. I also am not stressed or distressed, as we both have said now, that there's not a liquidity problem at the institutional investor level. So why would I sell at discounts, at large discounts? And so the portfolio sale market is basically on hold pending Q2 NAVs coming out, which will be in the late summer, early fall. We expect it to be a busy portfolio sale market September through December. But for now, everyone's waiting for the Q2 reference date, which takes that full COVID impact into consideration before that market starts moving again.
Yeah. Okay. And in the meantime, you're busy with constructing GP-led transactions and
Exactly. Trying to see which GP-led transactions will really resonate in this market. We've had a few GPs that signed with us. Both the GP and us as the advisor have agreed that this is not the right environment for them to launch in, mostly because their portfolio had a lot of COVID impact that needs to get washed through, and the company's coming back and showing more stability. Otherwise, pricing will be really, really onerous. So those deals have been pushed out to a more of a September launch, but there are certainly quite a number of high quality GPs that are launching now with us and certainly thinking about coming to market in the next few weeks. My closing remark really would be good assets from good GPs will always see time of day in the market.
Fantastic, Sunaina. So maybe as a last closing remark or question also, I mean, we talk about, the market, how it affected people, and maybe what about your firm, your personal life, any final observations on COVID, maybe some highlights even in this strange time?
Well, I think for me, the highlight has really been the wonderful, unadulterated family time. I always said that I wanted more time at home and in London because I was always on a plane for a living and really love that part of my job. But it's been refreshing to get these 3 or 4 months to really be home, be with the kids. I think that's fantastic. One of the first things I look forward to doing whenever the world, normalizes is giving people a hug.
Yeah,
and a kiss on the cheek. I don't know when that will be, but I do miss that interpersonal connection and the warmth of a hug or a kiss on 2 cheeks. So I look forward to that when things come back to normal.
Yeah. I mean, I have exactly similar feelings, and I started a little bit improving my cooking repertoire. And but you're absolutely right. I mean, the hugging is something that is missed. And sometimes when you watch a movie, you feel, what are they doing? Keep this. It's it feels like a completely different world. And it's But hopefully we will be getting back to this not in a too distant future. So many thanks, Sunaina. It was a great pleasure. As always, you've provided fantastic.
Thank you for having me. Appreciate it.
And hope to see you soon again. And maybe we can do a little bit also advertisement for something that we do also together, our Invest Europe Secondaries course. So on a more almost academic level, but also with a very practical view, we will have a full day long training course with Invest Europe. We have done this now for a couple of times. Last time was actually one of the last moments I've been traveling this year. Was in Paris back in February, and we will have another one in September, and I think it was probably going to be also remote. Let's see, but it's going to be something that will be repeated every 6 months. So another opportunity for those who are watching this, if they want to have a day-long version of this that is maybe more going down to the basics, but also getting you up to speed on the market. That's a fantastic opportunity. Thank you very much, Sunaina.
Thank you so much.